All right, let's get right into it. AECOM. They just dropped what you'd call a monster earnings report. I mean, they didn't just meet expectations, they blew them out of the water. Beat on revenue, beat on earnings, and then they raised their guidance for the entire year. And what did the market do? Well, exactly what you'd expect. The stock shot up. But you know us here at Iron Financial. Our job isn't just to cheerlead the winners. Our mission is to help you forge a portfolio that's truly built to last. And that means we don't just look at the shiny surface. We take it into the lab and we stress test it until it breaks. So the big question we're digging into today is this. Is AECOM really building a fortress for your money, or are we all just getting distracted by a beautiful blueprint that's hiding some serious cracks in the foundation? So first things first, let's make sure we're all on the same page about the sheer scale of what we're talking about here. This is not some flashy high-growth tech stock with a good story. No, this is AECOM. They are, quite literally, the #1 global design firm on the entire planet. These are the people behind the curtain, the architects, the engineers, the absolute master planners who build the world's most critical infrastructure. Think about it. We're talking about the highways you drive on every day, the water systems that keep our cities alive, and the massive environmental projects that are going to define our future. This is a Fortune 500 heavyweight, a true industrial behemoth.
Whoa, hold on a second there. Behemoth, giant. I'm hearing a lot of big, impressive words, but let's be real. A bigger company can just mean a bigger crater when things go south. Look, the market absolutely loves a good earnings beat. It's like catnip. But hype? Hype is a currency that goes to zero and fast. We've all seen this movie before, right? A company puts up some great numbers, the analysts all rush to upgrade their targets, and then everyday investors get sucked in right at the peak just as the music's about to stop. So the real question, the one we need to hammer on, is what's left when you strip away the headlines and the stock pop? Is this thing actually built to last? Or is this just another construction stock that looks great when the sun is shining, but will fall apart in the first storm?
And that is exactly the question we need to answer, which is why, today, we are putting AECOM through the full Iron Financial stress test. We are going to take this company apart, piece by piece, and inspect every rivet. First, we'll establish the sheer scale of this infrastructure behemoth. Then we will get to the good stuff and forge the bull case, looking at the hard numbers that have everyone so excited. After that, I'm handing it over to you to go hunting for the cracks in the armor. From there, we'll examine their blueprint for growth to see if they have a real plan. And finally, the moment you're all waiting for, we will deliver the definitive Iron Financial verdict. So, let's get to it. Okay, let's start at the very beginning by laying out the blueprint of this company. I mean, before you can even think about putting your money into something, you have to understand the size and the scope of what you are actually buying. So let's get a handle on this operation. The gravity of these numbers really paints a picture. You're looking at a Fortune 500 company, an absolute leader in their field. This isn't a small operation. They have 51,000 employees all over the world. They're on pace to pull in over $16 billion in revenue just this year. And check out where that money comes from. Transportation, water, environment. See, this isn't a business that chases fads or trends. It's built on the absolute bedrock of modern society. And like we said before, they aren't just one of the players. They are officially ranked by their own industry as the #1 design firm in the game. This is the top of the food chain. Okay, so we've established they're a giant. Now let's forge the bull case. Let's build the argument for why the stock might be a buy. And honestly, the numbers they just reported are so strong, they almost speak for themselves. This wasn't just a pretty good quarter. This was a statement, a demonstration of raw operational power. Let's start right where it matters most, the bottom line, the engine room of shareholder value. Earnings per share. Wall Street analysts, the so-called smart money, they were all expecting about $1.16. AECOM comes over the top and drops $1.29. That is a huge 13-cent beat. Look, in a market this choppy, any earnings beat is a win. But a beat of this size, we're talking over 11%, that's a show of force. It tells you this company is executing with absolute precision. And this wasn't some kind of accounting magic where they just squeezed out more profit by firing people. Nope, they delivered on the top line too. The street was looking for about $1.78 billion in revenue. AECOM brought in $1.85 billion. So the earnings beat wasn't a trick. It was fueled by real, actual growth. It tells us that customers want what they're selling, and they want more of it. Simple as that. Now this might be the single most important number on the entire page, their backlog. For anyone who's new to this industry, the backlog is the total value of all the work they have already been hired to do. It's a pile of signed contracts.
and right now it's at a record high of almost $26 billion. That's up 9% from last year. This isn't some sales guy's fantasy projection. This is a fortress of future revenue that is already built and locked down. It gives them a level of visibility and stability that most companies can only dream of. And you know what that massive backlog does? It gives management the confidence to do this. They didn't just have a great quarter and call it a day. They looked at the rest of the year and basically told Wall Street, you're not being optimistic enough. They officially raised their guidance for the entire fiscal year. The old range was $565 to $585 per share. The new, stronger range is $585 to $605. When a CEO does this, they are putting their reputation on the line and signaling that this momentum is the real deal. And hey, don't just take my word for it. Let's look at what the man in charge, CEO Troy Rudd, had to say. Quote, "We outperformed our expectations on every key financial metric in the quarter and raised our full-year guidance as a result." You hear that? That is not the language of a CEO who is just hoping for the best. That is the language of a general on the battlefield declaring a decisive victory. The bull case here is clear. It's built on a rock-solid foundation of performance, incredible visibility, and pure confidence from the very top. All right, I'll give you that. That is a shiny, well-polished bull case. The numbers look great, the CEO sounds confident, the backlog is a fortress. But you and I both know that here at Iron Financial, we don't just admire the armor, we test it. It's time to take out the inspection tools and start looking for the weak points. So let's begin the skeptic's inspection and see if we can't find a few cracks in this thing. Think about it. All that good news you just laid out, every single one of those strong numbers, it's already baked into the stock price. The market reacted instantly. So for someone thinking about buying in today, the real question is, what's hiding underneath it all? Is this foundation really as solid as the bulls want you to believe? Or are there hidden stress points, hairline fractures, that could lead to a total collapse when the pressure's on? Okay, let's get granular and put some hard numbers on this with our financial health stress test. First up, the Piotrowski F-score. This is basically a 9-point health checkup for a company's finances. AECOM scores a 7. I'll grant you that. A 7 out of 9 is a healthy score. But then we get to the Altman Z-score. This is a formula designed to predict the likelihood of a company going bankrupt in the next 2 years. AECOM's score is 2.38. Now that's not in the danger zone, which is below 1.8, but it's not in the safe zone above 3.0 either. It's squarely in the gray area. That tells me there's some underlying financial stress here. And then we get to the really heavy stuff. The debt-to-equity ratio is 1.3. That is a clear signal of high leverage. In a world with zero interest rates, maybe that's fine. But in the world we live in now, that debt is an anchor that can drag the whole ship down. That's a huge tangible risk. Now, let's talk about conviction. Let's talk about what the people who know this company best, the executives, the board members, are doing with their own money. So over the last 3 months, how much stock did these insiders buy on the open market? You see the number right there. A big fat 0. Nothing. Not one single share was bought. But wait, it actually gets a lot worse. While they were buying $0 worth of stock, they were busy selling. In that same 3-month period, insiders dumped over 33,000 shares of their own company's stock. So let me process this. The CEO gets on the conference call and says everything is amazing, the future is bright, but the people in the boardroom are quietly heading for the exits and cashing in their chips. For me, that is a massive red flag. Actions always speak louder than words, and their actions are screaming that they aren't nearly as bullish as their press release. And finally, let's be honest about the business they're actually in. This is not a software company with recurring revenue and fat profit margins. This is infrastructure. It's a tough, gritty business with huge built-in risks. First, demand is cyclical. When a recession hits, what's the first thing that gets cut? Big, expensive construction projects. Second, they live and die by government spending. A new election, a shift in political priorities, and boom, the funding pipeline can just shut off. Third, they navigate a minefield of regulations. And lastly, just look at the stock's beta, 1.34. All that means is the stock is 34% more volatile than the S&P 500. So when the market goes down, AECOM is likely to go down even harder. These aren't just temporary headwinds. These are structural risks baked into the very foundation of the company. Okay, those are all valid points. The debt, the insider selling, the cyclical nature of the industry, I'm not going to sit here and pretend those aren't real risks. But here's the thing. A truly great company doesn't just sit back and react to risks. It anticipates them. It builds a long-term strategy to make itself stronger and more resilient. And that is exactly what AECOM is doing with its blueprint for growth. They're not just waiting for the next contract, they're actively building a more durable company for the long haul. Take a look at this. This shows you how they're thinking about the future. It's not just about winning the next bid, it's about building a sustainable machine. They call it their Think and Act Globally strategy, and it rests on 4 key pillars. Number 1, investing in their people. Because in a business like this, your people are your product. Talent is everything. Number 2, transforming how they work, using tech, using AI to become more efficient. Number 3, extending client relationships. In other words, stop being just a contractor and become a long-term trusted partner. And number 4, and this is crucial, delivering sustainable legacies. This isn't just corporate jargon. This is about tying themselves to the massive, multi-decade megatrends of sustainability and climate change, which have their own powerful, non-cyclical funding streams. And this is not just talk on a PowerPoint slide. Look at the actual projects they are winning. They are the official infrastructure partner for the LA 2028 Olympic Games. Think about that. That's not a one-year job that can get canceled. That's a massive, multi-year, high-profile program. That is what we call sticky revenue. And on the other side, by focusing on sustainable legacies, they're winning the projects that will literally shape our future. Things dealing with water scarcity, decarbonization, and preparing for climate change. These aren't cyclical trends. These are generational problems that are going to require trillions of dollars of investment, which helps insulate them from the very short-term economic worries that you brought up. Which brings us right here to the final section, the most important part of our analysis, the iron financial verdict. We've built the bull case, which rests on stellar performance and that giant backlog. We've hammered on that case, and we've found some potential cracks in the armor. So now it is time to put it all on the scales, weigh the good against the bad, and deliver our final call. Is AECOM an opportunity to forge a stronger portfolio, or is it a trap waiting to spring on investors? So how does this all stack up? In the left column, you have the undeniable structural strengths. That record backlog of nearly $26 billion gives them incredible visibility into the future. They delivered a huge earnings beat, management raised guidance, and their profit margins are expanding, meaning they're getting more efficient. But you absolutely cannot ignore the right column. Those are the potential stress fractures. That debt load is significant, and it's a real risk. The Altman Z-score is in the gray area for a reason. The financials aren't perfect. The insiders are selling, not buying. That's a tough signal to ignore. And you can't just pretend the business isn't cyclical. That's the reality of the industry they're in. After weighing all of this evidence, after running this company through the gauntlet, our verdict is clear. AECOM represents an opportunity. Now here's why. The risks you highlighted are real, but they are known risks. They are out in the open, and in my view, they are manageable. Yes, the debt is high, but the company generates more than enough free cash flow to handle it. The insider selling is concerning, sure, but it needs context. It's not a mass exodus. And executives sell stock for all sorts of reasons: diversification, taxes, life events that have nothing to do with the company's future. What overwhelmingly outweighs these risks is the forward momentum. That record backlog is like a giant shock absorber that can cushion the blow of any potential recession. And their strategic move into long-term growth areas like sustainability gives them a powerful tailwind that should last for decades. When you buy AECOM, you are making a bet on the future of global infrastructure, and you're partnering with the #1 player in the game to do it. I have to admit that backlog is a powerful shield, but even the thickest shield can break if the attack is strong enough. Any investor buying in at these levels needs to keep a very close watch on that debt and on the health of the global economy. This is absolutely not a time to get complacent. No, you're right, it's never a time for complacency. But the question on the screen is the perfect one to end on. We are at the very beginning of a massive global infrastructure supercycle. The world has to be rebuilt, re-engineered, and made resilient for the future. So the ultimate question isn't about one single quarter. It's about whether the #1 firm in the world can ride that multi-trillion-dollar wave and build its way to a new all-time high. We believe the foundation is solid and construction is already underway. Thanks for joining us for this deep dive at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.